All right, welcome. Good afternoon, everyone. Welcome to Trading Coaches Playbook. This is Brandon Wendell with you. You should be able to see my screen, hear my voice, see me. Apologize for the last one. Anyway, welcome. And we'll go ahead and kick this off. We do a quick reminder here that we are not broker dealers or investment advisors. We're going to be looking at these markets from an educational standpoint. So I'm not telling you to buy, hold, or sell any particular securities. Give me a personalized recommendation about the markets. All markets do involve the risk of loss. That is always a situation. We can never eliminate that risk. We just try to minimize and manage it. We are also not subject to trading restrictions. So we can have positions in a security or initiate them at any time. Let me just go ahead and make a slight adjustment here for my lighting. It might be a little bit better. I don't know. We'll see. And yeah, so welcome everyone. And let's see. Today's topic for Trading Coaches Playbook is dealing with the volatility in the markets and what we can do about it. So before we get started, just keep in mind that we have a lot of things going on. We're very busy here at Wealth Builders HQ. And for myself, I'm in charge of several different programs. One of the main ones that keeps me busy on a regular basis is the E-mini think tank. In the bottom right-hand corner there, you can see basically if you're kind of confused and what's going on in the markets right now, and you want a little bit of guidance and direction, we have plenty of it for you. But like I said, one of the key things I do is every week, Monday, Wednesday, and Thursday, I share my views of the markets, specifically futures markets, and kind of guide you through those and how to trade certain opportunities. So, if you're interested in joining me for that, let me know. You can always email us at support@wealthbuildershq.com. But basically, we go out to these markets, and I'll look at a weekly chart here of the S&P futures because I do focus mainly on the futures. Obviously, stocks follow a lot of the futures, and the futures themselves are derivatives of the index. And the indexes are basically a group of underlying securities that are grouped together to gauge market health. And one of the things that we can see, well, maybe not here, but in order to understand how volatile these markets might be currently, we can actually click on something called the average true range, or ATR. And that's the line at the bottom, which I'll go ahead and enlarge a little bit here. And I'll leave it the color it is. But basically, you take a look at this weekly ES, and this is a continuous contract chart, meaning that it is looping together all the old contracts together. And let me just remove all the drawings to start fresh. Don't worry about this indicator for now. And we'll do back adjusted. Nope, it was. Okay, this means that basically it's taking all the old contracts and tying them together, but making adjustments for the different pricing and values and time of the old contracts. And what you'll see is this volatility measure, which is average true range. If you're not familiar with average true range, range is nothing more than the distance between the high and the low of any candle. And the difference between range and true range, so range, low to high of a candle. Pretty simple, right? And let's get a different color here. It pops out a little more. Oh, wrong one. There we go. So that's the range of a candle, low to high. Now, true range is the same plus any gapping. From the previous candle's close. So if there's a gap, then true range incorporates that gap. So for instance, well, it has to be gapping outside of the range. So trying to find a good example here if we have that. Most of these, the range would be just fine because it's including the close of the prior candle. Like right there, you see there's the close of the red candle, high, low, that's the range and the true range. But if we happen to have a big gap out, which you may not see too much on weekly charts, actually, here's one right here, because the close of that red candle is just slightly below the low of this candle. So that would actually be a little bit larger. It's not very dramatic, but then again, it's not going to be as dramatic on weekly as it would be on intraday. Anyway, I prefer true range because again, it's incorporating any gapping activity that might have happened from the previous candle and gives you a little bit more measure of volatility. So average range or average true range is simply that range averaged over X number of candles. Typically it's 14 periods or 14 candles. Let's see what do we have here for inputs. Yeah, 14. And I don't have a smoothing on it, but I can add a smoothing if I wanted to. Actually, it does. It smooths out the data on there. So they were using RMA, which is a different moving average. I'm not sure what RMA is. I forget. Let me see if I can find it. RMA. Let's see. People write codes for these different things. Let's see what it is. Figures. Anyway, it's some sort of calculation on the moving average, but I like to use exponentially weighted whenever I'm doing anything as far as weighting. Simple basically treats every single one equally. Weighted puts a little more weighting on the more recent prices. Exponential does a lot more weighting on more recent prices. So what happens is when you use something like RMA or SMA, it's not going to be as sensitive to changes in volatility, where EMA or WMA, those are going to be more sensitive. They'll change and react faster, which is what you want. You want something as accurate as possible to let you know what the volatility is doing. And again, remember, this is a weekly chart. And look what's happened in the last couple of months with our volatility. It went from this quiet 160 to this noisy, it's over doubled, 325. I mean, I wonder if there was anything that might have happened, you know, some announcements or anything that might have caused this. I'm kidding, of course, we know. The whole tariff war thing has started stirring up the volatility in these markets. So this is not unprecedented. Okay, volatility comes and goes in the markets. And before I erased my notes, there was actually notes that kind of predicted this bit of a turn down, to be honest with you. And again, going back in time, oops, sorry, didn't mean to do that. You could see that historically we've been here before, but it's been a while. As a matter of fact, when's the last time we were this high in volatility? In 2022, pretty much COVID, right? We were actually having more volatility than we did in COVID. And that was all happening in the shutdowns and lockdowns and all that good stuff. And you can see, look at it. Actually, this is unprecedented volatility. We haven't seen this even in the 2008 crash. Isn't that crazy? The markets are very skittish and very nervous right now. And, we have to bear the brunt of it. Fortunately, the price movement is not as dramatic, even though the volatility's gotten kind of high. Another measure of volatility. Now, see, this is measuring the volatility of the individual security. Okay, if you want to measure market volatility, one of the ways you can do that, especially against the S&P 500, is what's called the VIX or volatility index. Let me see, $VIX. And I'll go to indices. Let's see, there it is. Volatility, it's a CFD. There it is, index. And again, this is the measurement of volatility on the S&P 500 index for the next 30 days. Oh, these lines, I'm sorry, the indicators, again, don't worry about this one right here. This line is the average true range. So it's basically showing you that average true range of the security. Yeah. And again, that's volatility. So this, however, this is actually a volatility index, which is measuring the implied volatility for the next 30 days of the S&P 500. And once again, you can see we had a huge spike in volatility. We've had a few. We had one in August last year, and now we have another one here in April this year. And again, this is a weekly chart. So I can go back, and in 2020, we did see the VIX move higher, meaning the volatility on the S&P actually did go higher, but the price movement wasn't as great. And remember, when I was looking before, I was looking at the ES. This is the S&P futures. This is the average true range of the S&P future. So this is measuring how big the candles are, and this is the biggest candles we've seen on a weekly basis in pretty much almost the history of the markets. Well, at least in 1998, the beginning of the S&P futures. We've never seen that kind of average true range on a weekly basis. So what does that mean? Very big price swings. It means there's a lot of nervous investors out there. The fortunate thing is volatility. It's weird because price movement was higher, but volatility wasn't. Again, when I went back, I was measuring, in this case, VIX. This is an index that measures volatility of the S&P 500. And there you can see, yeah, 2008, we were much, much higher. We were higher in 2020 for COVID. And then even last year, we had a bigger spike in August. So there's been several shocks to the market, obviously. And we've got to be careful because it affects our personal portfolios as well as our intraday trading, right? So when it comes to risk management, again, this ATR, that's the indicator at the bottom, that's just measuring how big the candles are and therefore, how big price swings happen to be. And these last couple price swings that we experienced, March 31st and April 7th, the first end of the month and beginning of this month, last month, end of last month, the beginning of this month, you can see we haven't experienced that kind of swing before, ever. That's scary. But the nice thing is, what went down came back up, albeit it took longer for it to come back up, and we may not be done. I was saying before that part of what we can do is anticipate when changes in the markets are coming. And that's something that I focus on a lot in the mini think tank, as well as my other programs as well. And before I deleted it, as I was showing you here, I'll get rid of this ATR for now. This is my RSI, and I don't use it like a normal oscillator. Most people look at oscillators, which this is. It oscillates above and below 50, and they use those indicators to tell them when things are overbought or when they're oversold. And the traditional thinking behind that is if something is overbought, that's up here. If something's overbought, it's gone too high and it's likely to come down. And the other side of that would be if something is oversold, that is too low and it's got to rally. It's too cheap. That's actually a little bit flawed in thinking. The way again, I don't think that way. I don't subscribe to that. They also typically, when it comes to the style here, it's 60 and I'm sorry, 70 and 30 are the typical overbought, oversold levels when it comes to the RSI. So theoretically, if you go below 30, you're oversold and you're likely to get a bounce in price. Well, we've been getting bounces without going below 40, I'm sorry, below 30. Or if you go above 670, you're likely to drop. Well, we're not changing trends. We're just seeing little pullbacks. Why? Because when you're in a strong trend, overbought becomes more overbought. That's the nature of an uptrend. And oversold becomes more oversold. That's the nature of a downtrend. All right. Yeah, there could be an inverted head and shoulders on the indicator. Sure. I see that. But basically, what I look at is again, if something is overbought, it could become more overbought. And that's basically a bullish trend. That's it. It's a bullish trend. Obviously, bullish trends go up. And if something's oversold, it obviously could become more. And that is a bearish trend. And there you go. There it goes. Okay. So that's what happens. I mean, we get trends that continue in a certain direction. What I'm looking for is a change in the momentum. Okay. And basically, yeah, it did break the neckline right here, if that's what you're looking at. That's your inverted head and shoulders, neckline break. Should be a little bit of a pop up, and that's what we're getting this week, right? We've been getting a push to the upside. But even before that happens, again, what I'm looking at is a little different. My mouse is acting weird. Hopefully, it doesn't need to be charged. We'll see. First of all, when I use RSI, I use 60/40 rather than 70/30. Okay, so I use a little bit different numbers, and because it works. So to me, again, overbought can become more overbought. What I'm looking for is weakness in the uptrend, and overbought is not it. So I'm going to get rid of that. And again, in the bearish trend, oversold becomes more oversold. So I don't care about that. What I care about is lack of momentum, because really the way I read this is momentum is being measured with how far away you are from that center line. So movement below 50, which is the center line, is bearish momentum. The further below 50 you go, the stronger that bearish momentum is. And above 50 is bullish. The further you go, the more bullish you are. Well, think of it this way. If you are in a strong bullish trend, what you'll see is you should not become very bearish at all. Okay. So what do I mean by that? Well, basically, let's go back into previous bullish trends. Like we can go way back. All right, here's good. Okay, here we're in a bearish trend, lower high, lower low, and everything changed. And you can see for the rest of this move up, we were in a strong bullish trend, right? How do we know? Higher lows and higher highs in price. Pretty simple. But notice what didn't happen is we never became oversold in a bullish trend. So if you're waiting for it to go below 40 or 30 even, and then cross back up, you're never going to get a buy signal. Instead, I'm looking at how strong is our bullish momentum. When you think about it, when you're making new highs in price, every time you make a new high in price, you should be doing it with more momentum, not less, right? So as long as that's happening, the trend's likely to continue. That's kind of the same. Higher. There's some weakness. Notice we came down a little bit, but in between, we actually did pull back up. So basically, I'm looking for weakness in the trend. And in a bullish trend, the trend will end if we make lower lows, because you can't be in an uptrend if you're making lower lows. You got to make higher lows and higher highs. Okay. We'll get to a daily. Don't worry. And look at that. We're still going up, making new highs. Little pullback, but we're not in a bearish trend. How do I know we're not in a bearish trend? Well, remember, a bearish trend, you have to have lower high followed by a lower low. We don't have that yet, do we? We have a higher low right there. We're not below 40 on the RSI yet. So we're not in a bearish trend, at least not there. And what happened? Prices continued. Once again, we got some more weakness. And this is typically what I look for. This is called divergence, where prices are making new highs, but we do not have the momentum to sustain that. Remember, when we're making new highs, we want to see prices making new highs with the momentum making new highs. And when the momentum dies off, that's a warning sign that the momentum is getting weak and volatility may start to pick up as we start to drop in price. And sure enough, not only did we drop in price, we actually went below 40 on the RSI, which is a signal that we're going into bearish territory right there. And we actually made fresh lows. Notice the difference. We never went below 40 here, even though we made a lower high, and we never made a new low. Here we broke down. We went below 40. Therefore, when we rallied up, we ended up making a fresh low first. And it works the same way coming out of bottoms. We had a bearish trend I mentioned right here. because we have lower highs, just a little bit. But the main thing is we had lower lows. How do we know when we're coming out of a bearish trend? Well, right here, we're making a lower low in price, but do we have more bearish momentum or less? We actually have a lot less. And even on these last two little drops, those red candles, as I zoom in, I'm going to do it this way. Once again, we're making a lower low, and the momentum is saying, no, you're dropping, but you're doing it on less momentum. And of course, once we break highs, we're still in a downtrend because we have lower highs, lower lows. Right here, we went and broke the prior high. At the same time we broke the prior high, we also went above 60 on the RSI. You cannot go above 60 on the RSI in a bearish trend. And the trend changed. So going to where we are currently, there we are. We had some warnings. I mentioned that. For instance, we had a couple of negative divergences. Come on. What is going on with this mouse? All right. Sorry. To change it later. The first one, again, negative divergence, warned us that trend was getting weak. Didn't necessarily mean it was over, because this is just a warning sign. You need confirmation after the warning sign. So the first sign of weakness here, right there, okay, we're getting a pullback. Not necessarily going to be making a new low, but we're definitely getting a pullback. Notice we didn't make a new low, did we? We stayed above the prior lows. Sure. Sorry, hold on a second here. There we go. Okay. And then we made that next divergence and we broke down to a new low. As soon as we broke the new low, we also went below 40 on the RSI. What does that tell me? That tells me that we're going to be going down further. We're entering a bearish trend. We've finally gotten below 40 on the RSI. And what happened? Whoops. It was warning us. Now, looking at a daily chart, yeah, you're going to see a little bit more detail here. Again, you see the same divergences on those peaks that we had before. Price is trying to move up, indicator moving the other way, and prices drop. We did not get any divergence here on the bottom. Let me clean this chart up again. Oops, not indicators. Remove drawings. There we go. Again, if I go back to the weekly chart right now, we have gone below 40 on the RSI after negative divergence. That is the sign of a bearish trend beginning. Going to the daily chart, if we're looking for trend reversal from this downward move, we should get some sort of divergence. We do not have that. We're also not above 60 on the RSI. However, we do have the start of a bullish trend on the daily chart. Whether it'll last is another question. And I say we are in a bullish trend because we actually do have higher lows followed by higher highs. Yesterday's high gave us that new high. But it's a very weak uptrend and may not be able to last until we can get above 60 on the RSI. If that doesn't happen and we start turning around, we could easily break to fresh lows. And of course, I mentioned the volatility is rising. So what do we do when volatility is rising? Well, one thing, actually, there's only three things that we can do to control risk in the markets. And by the way, that's the only thing within your control. I've mentioned this before in previous classes with you guys in the Trading Coaches Corner or Trading Coaches Playbook, whatever we call this now. But I mentioned this a few times. Basically, when it comes to risk management or loss control, And literally, that's the only thing that's within your control is how much you're willing to lose if you're wrong. It really comes down to three key things: size, frequency, and duration. So when volatility rises, we need to control our risk because we can't control whether the markets are going to go up or down. Okay. So only commander in chief with his true social can do that right now, apparently. So we can't control whether the markets are going to go up or down. We can't control if we're going to win or lose when it comes to a trade. But what we can control is how much risk we're willing to accept on any one position, period. And we do that using those three key tools. Okay. The inverse head and shoulders and the RSI right before the rise, was that important? You're talking about the weekly? Well, it gave us a rally. Yes, it gave us a small rally. But again, without the weekly getting above 50 on the RSI, it's still not a big deal. We're still not reversing trend. Here we have a weak uptrend again because we have higher low, higher high, but no, not great. And if you go into the dailies, April, I wouldn't say this is inverted head and shoulders really. The reason why I wouldn't say it's an inverted head and shoulders on the daily is because that would be the two shoulders, and now we have a second right shoulder. So it failed. Yes, it broke upwards, but no, it's not an inverted head and shoulders. Because with an inverted head and shoulders, you have to have symmetry on both sides. And we don't have that. We have this big dip back here. So this would have been the head and shoulders, and it failed to break on that right shoulder. It ended up forming a second right shoulder. So no, I would not say this is the inverted head and shoulders. Not on this daily. Okay. And the only thing it is a bullish trend beginning with a lot of bearish momentum still. So I'm not convinced unless one of two things happens. For this to really be a strong bullish trend, we have to make another higher low without RSI going below 40. Okay, so basically we would have to see something like this. Prices pull back, rally back up. And when it happens, the RSI doesn't go below 40. Or the alternative would be, even if we do that or not do that, if we can get the RSI above 60 when prices rally, that would also be basically a break of the downward trend and confirmation the bullish trend's here to stay. But we don't have that yet. So to me, no, it's not inverted head and shoulders. It was on the weekly, but all it did was give us a correction of the bearish trend. Okay. So, like I was saying, basically, when it comes to volatility, the main one that we usually go to is size. And that really does help control the risk. Obviously, when it comes to size, we can do a lot of different things. You can do the number of shares or contracts or lots, whatever it is you're trading. But the other thing you can do with that is the type, especially if you're trading in futures, you can use minis or micros. This allows you to actively manage and trade the markets, but with less risk. Okay. So instead of trading the full size or the ES, the mini, you could do the micro. Or you can find other securities that have a positive correlation and trade those if they have lower risk or lower volatility. Now, to find correlation, you have to take a look to see. There's a couple different ways of doing it. I usually just use a website that shows me the correlations. Believe it or not, you could actually trade other securities that will mimic what happens with the S&P 500. So right here, if you use this link, I'll put it in the chat for you. It's actually HTM. There you go. That link takes you here. These are the futures contracts. And right now I'm looking at the S&P 500 If I go across, you'll see the Nikkei 225 futures. They actually do move 90% positive correlation with the S&P. But there are other securities that often will move with a positive correlation that's very, very high. I'm unfortunately not seeing any right now. They've broken down. That's the last 180 days. That's what it defaults to. You can check the last 30 days as well. And crude oil, believe it or not, has an 84% positive correlation with the S&P 500. Obviously, equity markets have positive correlation, but there are other things that often will have a positive correlation with the equity markets that you could trade that may not have the same volatility. And nope, we're not seeing any of that right now. So that's not really going to help here. In this case, like I said, the best thing would be to switch to a smaller size, either number of contracts or trade the minis to reduce your exposure to the markets. So number one, when volatility rises, and the way you identify volatility rising, first of all, you watch the VIX. And the VIX will tell you, again, that's the volatility of the S&P 500. So to identify volatility in the broad market rising, you watch the volatility of the VIX. There is actually a volatility index on the Nasdaq as well as the Dow, but for the most part, everybody just watches the S&P. That's more the broad market. The other thing you could do is you could actually look for volatility measurements on individual securities. A lot of different platforms will allow you to chart the volatility of different securities, especially if you're trading options. Let me move this out of the way. Come on. There we go. And one other thing we can do, I showed you earlier, you can look at the ATR of the security. If I look at the volatility or the ATR of the Nasdaq or the ATR of the S&P 500, it lets me know how volatile that particular market happens to be. You could also use Bollinger Bands. Looks like it's going to rain. Because Bollinger Bands are a measure of standard deviation away from an average. And what happens with prices in general, prices are mean reverting. That means that they move away from the average or the mean and snap back. Move away, snap back. And if the movements away are bigger, then your standard deviation is going to be greater, and therefore you have higher volatility. So we could add in Bollinger Bands as well. And you can see narrow Bollinger Bands usually means low ATR. Look at that. Whereas, sorry, there we are. When volatility goes up, what happens with Bollinger Bands? They get ballooned. Okay. And that's on the daily chart again. ATR, I usually keep it at 14. I've seen some at 21, so it's fine. 14 is the default. That's actually a throwback to when trading used to be, well, I mean, it still is for futures, about 6.5 days, almost 7 days of trading, right? Because you have Sunday, that's part of a day, Monday, Tuesday, Wednesday, Thursday, and Friday. Equity markets, they don't open until Monday through Friday. That's 5 days. So sometimes, it gets adjusted depending on who's setting up the indicators. But for the most part, most places still use 14. And that's kind of I guess a week and a half, almost 2 weeks of trading activity. Maybe a little more depending. So it depends. You can change it, but yeah, I usually keep it at 14. But whatever the default happens on the program, because most people are going to be looking at the default anyway. So there's no need to change it much. So like I said, if we see the volatility is increasing, I'm not necessarily looking at intraday here. When I'm looking at volatility and being worried about high volatility, I'm really looking at weekly charts. So even dailies are looking a little close. So weekly, again, same thing. You can see what's going on with the Bollinger Bands right now. They ballooned up. Why? Because that volatility rose. If you were to go back in time, you'll see, oh, there. Every time you get a spike in that ATR, you get a spike in volatility and the Bollinger Bands widen. Again, that's a measure of volatility. And there are other tools, like I said before. You can look for implied volatility. And there's probably other tools there, or I can just do volatility, relative volatility index. I don't know, implied volatility suites. Like I said, there's plenty of indicators out there. So, like I said, one of the things we do is identify the volatilities going up. And to protect ourselves, we can change what it is we're trading. Instead of just size, you can also go big as far as individual securities versus broad market. When you compare related securities, for instance, even the NASDAQ, or actually we'll do it this way, QQQ. Right here on the weekly chart of the Qs, you can see that volatility is high. The bands got wide. But, and that's showing what, 27 right now? If we were to look at, say, an individual stock, if I type it correctly, volatility has also risen. Individual stocks will typically have more volatility than a broad market will, because even the NASDAQ 100 is made up of 100 different stocks. So the fortunes or dangers of one individual stock is not going to sink the entire index, although some of them are quite large and could have pretty big impact. So one of the things you could do defensively, and again, let me go, yes, where my notes are, not just the size, but also to defend against volatility. You can change from individual stocks to the broad market if you're a stock trader or even options trader. Of course, there are times you want the high volatility because that actually can lead to good profits too. So it's kind of a balance depending on your personal preference and your risk tolerance. But by changing from individual securities to trading the broad market being the indexes. If you're a stock trader, it would be trading SPY, QQQ, DIA, IWM, the ETFs that track a group of securities. Even instead of individual stocks, you could do sector ETFs. Again, you're reducing your risk and the volatility exposure. You can see this if you go out to, let's say, Yahoo Finance. Oh, went to the wrong spot there, but that's okay. We'll go to home. And let me just say I type in individual stock like, Apple, just as an example. A measure of volatility versus the broad market, the S&P 500, is beta right there. And every stock, every ETF has a beta. It's basically measuring how volatile that security is versus the S&P 500. Apple is 26% more volatile than the S&P 500. That's what that means. 1.26. It's 26% more volatile. If you have a beta of 2, which some, you see this in some stocks, that would mean that you were 100% more volatile than the broad market. Let's see what Tesla's at right now. Beta, yeah, 258% of the volatility S&P. That means you're 158% more volatile than the S&P. So what does that mean? It means when things go wrong, they can go wrong very, very badly, very fast. So what could we do? Well, if we were to go back, or actually stay here, okay, if we were to stay with Tesla, we could see they're in auto manufacturers, consumer cyclicals. Well, we could change our investment and still stay in the same range. You could either find an ETF that trades auto manufacturers, or you could do consumer cyclicals, which is XLY. I'm sorry, that's discretionary. Yeah, that's discretionary. It's cyclical. I mean, I could look for cyclical specifically. And now my beta has dropped to 1.31, right? Or if I want to find automakers, I probably have to search. Let's do it this way: etfdb.com or ETF database. I can use one of the tools here, which is a screener, and try to find, or I can just Google it too. Let me see. I'm using Brave, but let's see. Automakers ETF. See if there is one. There we go. ETF database. It actually has one listed. So there we are. They're under consumer discretionary. Tesla bears. That's funny. Looks like they're all surrounding Tesla, but I'm just trying to find. Oh, there we go. Auto industry. That's a 3-time though. Yeah, let's see if there's another list. But like I said, we can find ETFs that track automotive ETFs. See if they have some. I just want the auto industry. I don't want Tesla, but it seems to be everything's tied to Tesla right now. Anyway, but like I said, my point is you could find ETFs or scan for ETFs that track exactly what it is you're looking for and trade those. And like I showed you, when you find them, the beta will be much lower, which means you have less exposure to volatility. Now, lower volatility means lower profits because you're also lowering the risk. But that is an alternative. And if you're trading futures, instead of trading in certain stocks and going to the broad market or sectors, one of the things you could do in futures, you can look for lower risk. One of the ways I find or measure, and I tell this to most of my students when they're brand new and trading futures, if you're trading futures, take a look at the point value and multiply it by the ATR. Okay. And basically, it should be under 1,000 for newer traders. If you're above 1,000, that means there's a lot of volatility and it could be very dangerous for you to trade that particular security. Right. So, what can we do here? We can go out to, say, barchart.com, and I'm going to go here to futures contract specs. And there's my point values. Okay, so let's take a look at the euro and see how volatile that is. Well, remember, I need to find the euro ATR. So I'll go to the daily ATR. So here we're on a daily chart. 6E. Just do the continuous version. Oh, typed in 6E. And we have 0.01288. Times 125,000, and that is $1,610. That is above 1,000. That is a very volatile security right now and may not be one you want to trade. Okay, let's look for something else. Let's go to the Swissy. That is now 1626. That's going to be the same problem because that's actually higher. What about the Loonie? 00530. That's the average true range. And the point value for the Loonie is $100,000. That's 533. Is that below 1,000? Absolutely. So Trading the loonie is an alternative for currency trading versus trading the euro or the Swissy, which is much more volatile. You take a look at metals, same thing. We take a look at gold right now, that's $100 a point. Okay. But the daily gold ATR is 83.6. That's 8,300. Is that a good thing to trade? Again, the point value is in futures is how much 1 point is worth. Yeah, it's in futures. So let's see copper. Copper is a point value of 25,000, but the average true range on copper may allow us to trade it. We'll see. HG 1761.1761 times 25,000. And that looks a little volatile right now. Okay, well, what about the micros? Like I said, they're out there. The micro copper said 25,000, that'd be 2,500. And again, the ATR 1761, that's okay to trade. Basically, what this is showing you is if you actually bought the high and sold the low on any given day, how much would you lose on average? That's what's literally showing you because it's showing you the ATR. Or if you were to short the low and buy back at the high, what's the absolute worst case scenario? What would you end up losing most likely? That's what this shows you. So when we start comparing different securities here, I go out to indices or financials or grains. Yeah, I'll go to grains. Actually, we haven't done that. Corn. Again, you just look at the average true range of that security. CS, that's soybeans, sorry, not corn, 16.25. 812.50. So is soybeans, are they relatively safe to trade? Yes, because the volatility is not out of control. Worst case scenario, if you bought the absolute high of the day by mistake and sold the absolute low, on average, you lose $812. That's under 1,000. Now, could that still be devastating? Absolutely, especially if you trade too many contracts. Now we look at corn, 8.8 and a half, showing 8'4. That's 8.5. That's only 425. So what does that mean? Again, it's under that 1,000 point range and therefore should be okay for traders who are looking to reduce their risk. So going back, we saw that we can change the size and type that we are trading. And if we want to be a little bit more defensive against volatility, we can change from individual stocks to the broad market because the beta is going to be lower, meaning the volatility against the broad market is going to be lower. Or in futures, you could take whatever the point value is for that future, and every future has a set point value, and you multiply it by the average true range to get an idea of how scary that security is. Now, frequency, that is the number of trades you take. The more trades you take, the less selective you are being, and the more likely you are to make mistakes. So when the volatility goes higher, we need to slow down a little bit in our trading and be more selective. The other night in the E-mini think tank class, basically we had a Q&A session. And in the Q&A session, it was really good, actually. We had this Q&A session that we do on a regular basis for the class. Students came in and we got together. The recording will be up pretty soon if it's not already posted. But basically, I went over one of the tools that we have available. Again, I go to my E-mini think tank quarterly. And under bonus material, one of the things we were using was this tracking sheet and calculator, and we had a trade scoring worksheet. So to slow us down, let's see if I have it somewhere already. I don't need to re-download it. There it is. So to slow us down and make sure we're only taking high quality trades, we were rating the trades. And depending on how they rated, we would either just jump in with a limit order or we would wait for a little more confirmation. And it basically is a step-by-step process that, again, the whole video is recorded. It's a step-by-step process that you can use to be more selective in your trades and only take the highest quality trade opportunities. So by doing that, it filters out a lot of the noise. We lower the frequency of trades, and the less trades you get into, the less likely you are to make a bad trade. Now, it's not impossible, right? You can still make bad trades, even if you only make one trade a month. Could be a bad one. But the probability is higher if you're more selective. And then finally, probably another easy thing to do is duration. That is the length of the trade. And it also refers to the time frame of the charts used. The bigger time frames you go to, you're going to filter out a lot of the noise. Notice when we went from weekly to daily, we had smaller or bigger moves, bigger ATR, not bigger ATR. Sorry, we had more moves, more noise. The lower you go in time frame, the more noise you see, and that noise is increased by volatility. And noise is basically movement up and down or back and forth. Bear with me one second. I gotta check something. I was just making sure. Believe it or not, there's a wild turkey that's been floating around by my chicken coop right now. So I was making sure they're okay. That's what happens when I live in live in a farm. Anyway, it's not something you expect the trader to be talking about, right? Wild turkeys annoying my chickens. Anyway, so getting back to this, like I said, duration is looking at the time frame. The longer you're in a position, the more risk you have because more things can go wrong. Hold over several weeks, several months, even over the weekend or overnight, you have more risk than a day trader does. But when it comes to volatility, you got to be careful there as well because typically the if you take a step back and go to larger time frame charts, you remove some of that volatility. Like I said, I'll just use the NASDAQ as an example. This is the current NASDAQ futures. If I go down to a 5-minute chart, and let's clear this chart, you can see all this noise. Things are very choppy back and forth, right? So you may be more you may be more attracted to taking more trades. Whereas as we start zooming out, this is a 5-minute chart. Maybe I go to a 60-minute. Notice how the price gets a little more smoothed out. You go to a 4-hour, it's still a little choppy, but a bit more smoothed out for the overall trend. Go to a daily, overall trend, much bigger moves and smoothness. And then, of course, weekly as well. So to filter out the volatility, you could go to a higher time frame. Even though normally that's something we do to reduce risk, we would go to a lower time frame rather than a higher time frame. But with volatility, to get rid of some of that volatility noise, you go to a higher time frame. And actually, in the E-mini think tank, one of the things we did on Wednesday when we were trading in our live session is we stopped looking at some of the intraday trades and started looking at longer time frames, some daily and weekly trades that we could go ahead and jump in and not worry about the intraday noise. So those are some of the things you could do to combat the high volatility that's coming right now in the markets, as well as identify some opportunities. Yeah, I mean, well, I would go maybe from 15 minutes to an hourly. Or instead of doing intraday trading, go to longer term swing trading overnight by using hourly, 4-hour dailies. But yeah, that would whatever you do when you go higher time frame, you reduce some of that noise, that wiggle in between. Like I said, on the weekly chart here of the ES, right now, we're still in a bit of a bearish move. You can see we have lower high and lower low. We're getting corrections back up. And if you go into the daily chart, you see a lot more little quick moves back and forth. You go to a 4-hour, there's a lot more movement back and forth. So there's more trading and more activity going on. Higher time frames, less back and forth, more of an overall move. So that's it. Anyway, I got to run. That's the end of my session for today. Hopefully, it gave you a little insight. Like I said before, if you're interested in learning more about what we do at the E-mini Think Tank, let us know. You can hit us up at support@wealthbuildershq.com. And I believe they might be running some specials still, and you guys can keep an eye on that as well and email us to find out more about those things. So thanks everybody for being here and have a great week, great weekend, and trade safe and trade well. So take care.